Hello everyone, sorry that I didn't manage to produce a video last week as I was away. So in this video, there are quite a fair bit of things to discuss and share, such as the various events that had happened over the last 2 weeks, summary of earnings from the various mega cap companies, the recent strong rally in the stock market, and also my view on where is the market heading from this point onwards. There are timestamps in the description box below, so feel free to skip to the segment that interests you, and I really hope this content can bring some value in your own research. I'm doing all this for free, so if it does benefit you in one way or another, do help to like this video and subscribe to my channel. I really hope to grow this channel. Okay, it was an eventful week. In case you hadn't had time to digest or follow the news, here's a compressed and summarized version for you. Firstly, GDP came in negative for a second consecutive quarter and we are technically in a recession now. Then we had the Feds raising the interest rate by 75 basis points again. Next, the earnings from various mega cap companies were poor and weren't convincing. Lastly, personal consumption expenditures aka PCE, inflation rose 6.8% in June, the biggest 12-month move since the 6.9% increase in January 1982, and that's like 40 years ago. With all this bad news, yet the stock market rallied, and it rallied hard. They say market is forward-looking, so when a market rallied on bad news, it could be a signal of the bottom. Is that the case now? I will cover more on that later, but basically, that's the summary of what had happened over the last week. And before I share my view on the market outlook ahead, I just want to quickly touch on 2 of the 4 events that had happened: recession and the earnings. First up, many people, including several YouTubers and financial gurus, are discussing and debating on whether we are in a recession already. In fact, the term recession has become a changed term in recent weeks. Purely by definition, recession is identified as 2 consecutive quarters of negative economic growth, which we are experiencing it right now. To add on, the 2-year and 10-year Treasury yield curve has been inverted since early June, and for those who are not aware, this is usually an indicator for a recession. On the other hand, we have President Biden and the other group of people or economists saying that this is not really a recession yet, as in the past, a recession has never been declared without a loss of employment, and we are talking about massive unemployment, but we don't see that right now as the job market is still strong and robust. My take is, recession or not, it doesn't really matter to me when it comes to the stock market. I have done a video on recession versus the stock market about 4 months ago, which you can check out the link on top or in the description box below. So the gist is, stay invested. In fact, investing during recession is likely to have high probability of profitability, as there is always light at the end of the tunnel. Based on this table, the average return for 5 years after the recession is actually a whopping 120%. Next up, here's a quick summary of the year-over-year revenue growth by S&P 500 and the various mega cap companies. Full credit to this Twitter user. So as you can see, apart from Tesla, the growth for other companies weren't fantastic. And if you dive in deeper, you will realize that Tesla, Google, Microsoft and Apple are experiencing the slowest growth since 2020. For Apple, their beating estimates in actual fact is a decline of nearly 11% profit year over year. Therefore, when you look beyond the surface, you will realize how much false growth we had over the last 2 years when the Fed printed almost unlimited money. So now we are sort of back to reality. Meanwhile, I just want to spotlight Meta aka Facebook. It's concerning for me as a long-term shareholder as it experienced a negative year-on-year growth. In my view, this is the slowest in the company history. Their forward guidance also indicates that this will likely happen in the next quarter. I have previously shared that their pivot process takes time, and long-term investors need to give the company till at least next year if you are hoping that it can turn things around. And that's what I'm doing right now, not selling any shares yet, and also not adding any more. Come next year, it's probably time to make a call whether I would still want to be a long-term holder of their stock. So, the market sort of went on a massive rally despite the various bad news. Are we ready to charge towards the all-time high? Here's my take. Long story short, I am not convinced yet. My view is that the market entered last week with a very cautious approach, and there could be too much bear bias. So this really is to squeeze the bears and shorts really hard. But on the other side of the story, another group of people may view that the bottom was in as the market is forward-looking. What does that mean? Let me explain. The market has started its decline since about half a year ago because the market was forward-looking and was pricing in technical recession, subpar earnings, inflation, and interest rate hikes. And in case you are not aware, market doesn't like uncertainties. So now that all this had happened and market had certain level of certainty, it rallied. So now the market probably is looking ahead again and believe that months ahead things will get better, such as Fed turns dovish, inflation gets curbed, and earnings will improve. So who's right or who's wrong? Honestly, this is a probability game. It's anyone's guess. I am prepared to be wrong, and this could be a bull run to the all-time high. And this brings me back to something that I always preach, and that is other than macro factors, it is also important to look at the technicals. The stock market needs to reclaim some of the key resistance levels and break out of some of its downward channels before we are ready for all-time high. Okay, so now let's move on to the technical segment. Starting off with the broader market, SPY. I have posted on Momo on 19 July that SPY needs to break above 400 to unlock more upside, and may go as high as 415. Currently, it appears that it is moving in this manner as we went up to 413 on Friday. And this is what I have been sharing about. Don't try to predict whether the market will go green or red today, tomorrow or next week. Instead, one should watch out for key levels and trade with the trend. So for this case, if investors had realized that SPY broke and closed above 400 and traded with the trend, they would have been able to ride a 12 points uptrend from 400 to around 412. Anyway, 415 presents strong resistance, followed by the 200 moving average at 430. In my view, the entire market will be considered bullish if SPY can reclaim the 200 moving average. But at this point, I think it will likely face some form of rejection at either 415 or 61.8 Fibonacci retracement level, which is around 422. On the downside, 400 should offer a psychological support, followed by the 50 moving average at around 390. I would think if 400 breaks, we could potentially pull back to sub 390s. Thereafter, watch out for the little gap between 379 and 380. It will likely act as a magnet to pull the stock down once 390 is breached. Moving on to Apple. Again, have posted on Momo that once a key resistance has been broken, the stock can fly. For this case, the level was 158. And Apple punched through this level and flew up to as high as 163. A 5-point movement is relatively huge for Apple stock. So a reminder again, trade with the trend and don't try to predict. Anyway, Apple is looking bullish at the moment. Since it hit a low of 129 in June, it has cleared so many Fibonacci retracement levels and resistance. To add on, it also reclaimed the 200 moving average. With all this said, in my view, this run-up is too fierce and parabolic. We could expect some pullback soon, especially when it is around the 61.8 Fibonacci level right now. But a quick disclaimer, this does not mean that we should short the stock or buy puts. Instead, I wouldn't buy a call now. As for buying puts, as usual, watch out for key support levels. To highlight, there is a gap at 157 to 159, and that is also where the 200 moving average is sitting right now. In my view, this will be a battleground between the bulls and bears, so watch how the stock move around this area, whether it goes above or below this area. And for trend confirmation, I would think the stock needs to close above or below for about 2 to 3 days. Finally, to add on, the stock has been kissing the top of the Bollinger Band for a week, and I personally think this is not sustainable. It will probably pull back to maybe around sub 150s range unless, yes, there is a caveat, unless I'm wrong and the market has put the bear market behind us and is on its recovery mode to all-time high. Next, Tesla. Once again, I have shared that if 823 and 827 are breached, we could go up to 880s range as there were little resistance in the middle. Hope this had benefited some of the viewers. Anyway, the next resistance for this stock is the 200 moving average at around 909. To highlight, there are two things that Tesla share in common with Apple, and they are: number one, there is a gap below waiting to be filled, and number two, it's hugging the top of the Bollinger Band. In fact, it actually broke above that. So is this sustainable? In my opinion, no. But that being said, this does not mean that we can expect a waterfall down. I am just expecting a pullback soon, but I can't be sure the extent of it. As usual, the gap at 751 to 764 will act like a magnet to pull the stock below 800. This may seem crazy since it's near to 900 now, but who knows, I could be wrong. Okay, a quick one on Meta. Previously, I've mentioned that a bad earnings report or forecast by the company will see the stock sink to 150's range, and it did. So where do we go from now? On the upside, one huge resistance is 172. If Meta cannot get above this level, it will remain bearish, after which it still has to clear 185 to even have any slight sign of reversal. On the downside, I don't even know what to say. It's already very beaten down. So will it go even lower? I'm not quite sure. If the broader market tanks, then yes, stock like Meta will see more weaknesses than others. And that is where I think the pandemic low of 130's range could be in picture. However, if the broader market does not plummet, Meta could just trade within the downward channel that are marked by the two red dotted lines. Once again, this is not a financial advice. Alright, here are my end thoughts. Some investors may wonder why the market rallied so hard when things are still looking bad. Well, all I can say is, if there is only one takeaway from this video, that would be, don't try to make sense of the stock market, right on it. The key thing is, know the technicals and trade with the trend. But if you are a long-term investor, I think it is okay to buy the dip periodically, as you should be fine in years to come. And I have been adopting both approaches during this bear market. Finally, learn not to chase the upside and panic on the downside. Even if I am wrong and this is a bull run to all-time high, there will still be a pullback along the way, and you and I can still enter if we eventually believe that the bottom was already in. Alright, that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. Your small action will keep me going. Thank you.